Greetings, market rebels. Welcome to this week's macro measure. It is Sunday, June 18th, 2023, a little bit after 9 a.m. here on the East Coast. I'm Wayne, my partner Ryan's working on the market outlook for the week. Happy Father's Day to all of you dads out there. Let's do what we need to do, and then we can get into the more interesting stuff. Here's our trusty disclaimer. If you please have a look at that, and our trusty intellectual property rights notice. If you please have a look at that, and then we will flash this, which is the plan program or this week's stream. Since I am not the most organized speaker, never have been, probably never will be. Anyway, this is what we're going to be working off of. I'm going to actually work off of this myself. I'll put this off to the side, and then we'll talk about things in browsers and browser tabs, and then of course on the charts. So I'll leave that up there just for another second or two. If anyone wants to copy that, put it on print screen, whatnot, that kind of thing. So probably not perfectly spelled here, all that, but I wanted to get this taken care of because I'll get a lot of pressure if I don't, if you know what I mean. So let's now move this out of our way. I'm going to move this over to one of my other screens, and then I'll be able to cover things. So let's start out with, we'll come back to this browser. I'll just talk about the bottom line on a few things. I'll come back to XLK, but really the rally that started the prior week really continued, right? That's what we were wondering about in terms of a melt up. And I think it did start to feel like a melt up really on Tuesday, Wednesday, and Thursday, and then Friday we kind of finished with a whimper. I think that was because, right, you probably had a great somewhere between 3 to 5 trading days that were just phenomenal, and a lot of stocks ran. And so if you're a short-term player that caught that, which I think a lot of folks did, I'd like to think that anyway, you got really overbought. This upper Bollinger Band here on the SPY that we're looking at, the SPY daily going back through the end of 2021, but this is set to 3 standard deviations to the upside, just to give you an idea. Now granted, right, this consolidation that we worked our way into for the first part of the year in SPY, overall this was kind of narrow relative to this 2022 action, so it did sort of bring the bands into a narrow state, but still it took 3 standard deviations to really contain the data, if you will. And Thursday you could see that you were full 3 standard deviations away from your 100 SMA, which is what I have the Bollinger Band set to. The RSI readings were up there as well, maybe not extraordinary on the SPYs as much as the Qs, but you really have to go back to get to a SPY reading on this daily chart in RSI that I'm mousing over. You've got to go back to here, right? And that is the summer of 2020 to really eclipse that. This one's pretty darn close, which was during the latter stages of the post-COVID run that we had. So it is what it is. It got there. This is now, I think, you probably saw that Friday action where people just said, hey, it's been an amazing run. This stuff is stretched, and now let's be smart here. I mean, that's exactly what I would do. I would rather, if this, let's say, continues next week, which again, we shouldn't laugh at and say it can't happen. I don't think it will. I think the most likely scenario is that you pull back, but the problem with that is that we're not the only ones that know that this market is extremely overbought in the short term. So they could make it difficult. It might just plunge, right, and surprise people. But you might get that quick sell-off. They try to rally, it fails, boom, you start dropping back down. But that may not happen. They may be able to hold things for a while, and that's why I'm saying you probably get a pause or a pullback. I don't want to get presumptuous. I just feel like, given all the things I've looked at, objectively speaking, there's the things that led this rally became very, very extreme. And usually when you look back on these extreme overbought readings, in retrospect, it really is a good place to sell or have sold, right? So that's what I would say, that all we really can work with, right, is the normal tendencies and some things that these indicators and things like that to help us gauge things, but you can't really say for sure, right? It's still really all about just finding what the conditions are, assessing conditions, right? And then expecting certain scenarios given those conditions, which again, it kind of makes it an art. It's just not that easy to do. But everything pretty much participated, right? The cues were rocking and rolling. There's absolutely no doubt about that. Making sure I've got this. Yep, okay. They almost got the 3 standard deviations from the 100, but they became, right, if you look at the Q RSI reading on this chart here, this is, again, they're sticking with the daily for now. You've got to go back to here. You've got to go back to just in front, really, of the all-time highs in the Qs to get anywhere close to this RSI reading. So this has been extraordinary, and I think that's why some people were smart and took profits and said, look, it just overbought, it's super stretched. The diamonds also, they got the industrials, they got some big discretionary names going, and things like that helped the diamonds. They didn't get nearly as overbought on a Bollinger Band basis, but they did participate. Let me just try to drop this down a little bit so that you can see that better. They did participate overall, right? But was it anything great? No, but this has really been the case, right? The Qs, followed by the SPYs, followed by the diamonds, followed by finally IWM. That's the kind of strength ranking order we've been noting for some time now. It's not like we do it week in, week out, but that's basically been the case. And IWM really has not participated all that much. You could see that really Friday's close doesn't leave us all that far removed from where we were on the open back on 6-7. So what was that? Was that yeah, that looks like it was a Tuesday, roughly speaking. So yeah, you really haven't done much since that Tuesday open. And to me, this is kind of the canary in the coal mine, where I see a lot of these perma bull types that are taking victory laps. This is, I guess, how it always is on Twitter, apparently. But they're excited about this, that, the other thing. But to me, I continue to point out, just objectively speaking, that I just don't think that a lot of things that would normally suggest that things are really doing well under the surface are there. So even like economic reports, leading indicators, the IWM, right? Small caps really not roaring. Did they finally break out? Yes, but I feel like this is more of a case. This is kind of where it gets into a little bit of a feel. I feel like it's more of a case of where it was forced, and a lot of players maybe just said, well, eventually if things are really as great as the market's telling us, then the IWM will start going. We may as well start getting involved here. I think that's pretty easy to see how that would happen, because sentiment can really change how people approach things. I think we know, anybody that's been around knows that people hate being wrong, especially in public, and this is why I think digging your heels in is not the way to go. I think you can have these really pound the table forecasts and all this stuff, but that makes you susceptible to a lot of problems. And I've already got enough problems with a lot of other things that aren't even of my making, and so I'd need less problems, and I don't really want to create my own. So I think that's where being open-minded and kind of trying to be objective as you possibly can is what will aid you or help you, assist you the most over the course of time, and when you're in the equity market trading it actively. But anyway, that's not impressive to me. So I want to dive into a few other things. I did cover a few of the review and summary points. We did talk about the force feel to it, the sleeper scenario, the melt up that we've been talking about. Those, right, the melt up that was probably came courtesy of the sleeper scenario. I think that is either upon us or or at least it has started, right? This type of ascent, because what I've noticed over the course of time, there's a lot of things I think you just notice. And a lot of times rallies start out on a certain support lines and things like that will be on a certain slope. And then that slope will often increase a few times. So you can go from sort of a more of a mild or reasonable slope, and then you sort of get slopes that are a little more aggressive, and then they become progressively more aggressive, and eventually they become too aggressive near these kind of final points. And so there's an example of something I think that's gotten progressively more aggressive. And I think that also sows the seeds of failure, right? Because we know, especially with an index ETF, major index ETF, stocks can stay vertical individually, I think, a lot longer than an overall index, like something like the QQQ ETF. So could there still be more? Yeah, we can't really say there isn't. I think the problem is that where are you going to start? Where are you going to start fighting against this? Right. I would have personally mentioned on Cocktail Hour that I wanted to step in. I'm not, excuse me, I don't make a habit out of trading counter trend, especially to super strong trends. But I'm ready to step in. I think you have to be at DEFCON 2 at this point because of the extreme overboughtness and the kind of degree of the rally. Now, I think I calculated it. I think we're up. I don't even want to go into this because I could be wrong, but I think since the start of the year, this thing's up. I don't know. I want to say it's dramatic. Where's that October low? That's back here. You started the year where did we start the year? Yeah, so I think you're up about 40% in the Qs, I think, in in the first half of the year. So, there could be a little more. Maybe there's, 1 or 2 more days, maybe 3, who knows, of just utter madness to the upside. But I think whenever you run out, whenever this exhausts, I do think that clearly, right, we should see some kind of a pullback. Where that gets to, I don't know. Where you have to say, well, that cracked the trend, I don't know. At this point, I think more data would be ideal, but I would look at this for now, I would let me put a number on this. I'd say around 363. The problem with being a bear here is manifest, right? And manifold. You've got support lines that'll come in off of the prior price action. You've got the rising SMAs that will all act as support as well. There's prior hesitation points that seem to have mattered, or levels, sort of like, again, flat lines that we use, rebel levels. There's all those things waiting for this to back off and to help support it. And so there's players that focus on a combination of all the things we just talked about that are probably saying, well, the trend is up and I can't wait to just buy a pullback. So it may not be easy. Then again, maybe it will, right? Maybe this thing has gotten so ridiculous in terms of degree, it just slices right back down and through. I would say, look, the real level for me right now, is unfortunately down at 363. So you're still, let's say, over 1% away from really, I think, having this thing crack. Could you get in earlier? Sure. But what you've got to do, in my opinion, these are all my humble opinion, just from my own experience, is you've got to pick a point that you're trading against, as Ryan always notes, right? And you realize that you've got to keep it on a short leash. Fighting against a strong trend, even when it's obviously ridiculous at this point, right? Based on, say, RSI or this, that, and the other thing, you've got to pick a point and you've got to put a little bit of a buffer. If you say I'm 1 penny, get me out 1 penny higher than the highest high, and you trade, you start buying puts somewhere in this proximity, trust me, if they have any chance at all to exceed that high by 1 cent, they're going to, right? This is where they run the stops. So that's the whole art of the little buffer zone. You have to be willing to take on a little more pain beyond there before you're willing to capitulate. Otherwise, you'll find yourself, this is my opinion, you'll just find yourself capitulating inordinately, an inordinately high percentage versus what you'd expect. So just remember, we're not alone. Okay. So there's a lot of people, of course, out there that have the same or similar charts that are thinking the way we are, that want to short this thing because of how absurd it became in their eyes. So just be on guard for that. So the sleeper scenario, as many of you remember, right, that is activated now, and I'm at DEFCON 2 because I think you have to be on this kind of these absurd readings. DEFCON 2 is due to the extreme overboughtness. I'll show some of that, sort of like an XLK. I think it shows up the most, especially like in some of these technology stocks. the AI revolution that people are thinking is going to be this, that, and the other thing. I wouldn't doubt that ultimately it is. I just don't know if it has these wonderful effects over the next quarter or two. The way that a lot of these players seem to be thinking, or at least positioning themselves. But we were waiting for this. Let's see, where are we? Yeah, we were waiting for the SPY 431.73. We rounded it off to 432 to be taken out. And we said this could create a 1 to 2%, maybe a little bit more of a melt up if it were taken out. And I'll put this near 432. So that would be somewhere around there, right around there. And that you could get short covering, capitulation, yada, 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 all that kind of stuff that would drive the market kind of haywire to the upside. And then that could be a short-term top at the very least. So we got that. We got the first part of that. I was ready to scrap the sleeper scenario a couple of times, but thinking when they had the market kind of struggling here and there during the earlier part of the year, but they did pull off that initial strong push through. And now, right, it got overdone to the upside. Remember, 3 standard deviations to the upside from the 100 SMA mean. And now you're looking like this, right? You backed off. And again, that to me is just natural market action on a Friday after the last 2 weeks, especially the final week of hyper madness, right? Where they were just chasing everything dramatically. So the sleeper scenario is that you start now coming back in, and then we have to wait and see what's next. This is just how I chart. I want to wait and see, like, where does it support? Where does it try to rally from? If it does rally, how high does it go? Does it produce a higher high? Does it produce a lower high? Produce a similar high with negative divergence, right? Does it have a very meek rally attempt that just fades quickly, right? And that's suggesting that there's a lot more downside maybe in the short term in terms of a pullback. Does it pull all the way back to the breakout level? Does it come back and fill this gap in here that we'll just drop a little oval on? These are the things that are, you would be going through our minds, but you've got, this is what I would say, like, especially for short-term trading, like, we don't have to predict that. We just have to know that it's a possibility, right? And then when certain factors start to appear, we could say, look, this is starting to shape up, like this corrective activity is very widespread and severe, and they're really selling this, or this macro development caused this to happen. So that's what I would sort of think about in terms of shifting our thinking when the time comes. But for now, right, if you do take a counter trend trade here, just realize I'm taking a counter trend trade. Where my question is always, where am I? I tell everyone this to see if it will help them too. Where am I in the grand scheme? Where am I? Well, I'm in an uptrend on this daily chart. If the uptrend became exceptionally strong over the past week, it may have pulled off a melt up crescendo, may have. And if it does, what happens next? Well, it needs to crack something. I'm not a big fan of, unless you're going to use intraday data, which is fine, but I think less reliable than daily data. There's more noise, in my opinion, the lower the time frame you go, and there's more signal the higher the time frame you go, in my opinion. So you can trust things to be more reliable the closer you get towards monthly or quarterly than you can on the 1 minute or tick charts, put it that way. So there's the old, well, where do I go start fighting against this? I don't want to wait too long. There's a lot that goes into even a simple thing like that. But I would just say, look, keep it on a short leash. You really want to take your shot and just be a quick roller, right? If you can get that quick roll in, you buy it. I always use a 10 lot as the base. Let's say you buy 10 puts and whatever, and it seems like it's working out, just sell 1 or 2 that when you make, say, I don't know, 30, 35% on the put. Right now, you've done what I call the quick trim. And that way, if they do work it back on you, it wasn't a complete exercise in futility or frustration where they take it back. And now you're right back there facing what was a little bit of a winner is now possibly turning into a small loser or break even. That can be frustrating. Get a quick trim in, the stock still drops, you still hold 80%, you're still happy. Stock goes back up, you get out for break even on the final 8 you hold, you're still a winner. no harm done. Pick your next spot, positive attitude. That's what I mean by the quick trim. So I don't want to go too far off the rails like I always do, but I just feel like a lot of people are going to be tempted here. So I just wanted to make some things clear. If you're not in any market rebellion services that Ryan and I are in, and you're maybe in AJ's or something else, right? This, hopefully something like this may help you, because I don't know if they share that. I don't know if AJ and other folks share the same philosophy. Anyway, so the sleeper scenario is activated, has a chance to shine. The big question is, right, sustainable. Is this sustainable? And I don't think it is in the short run. We'll see, but I'll show you some things I think that'll kind of suggest that maybe that's not the case. Let's see, with this is now a good time for us to go here. So what we'll do is we'll go here and we'll do our check on starting from left to right on these tabs, just to bring up some key points. And this should correspond to some degree with the this week's stream, all the points that I've got laid out there. But here's your 20% of stocks above the 20-day average. And you can see that this didn't get extreme, but it got up there. I mean, this is another one where I would say, look, this is good enough. This is kind of good enough for a possible short-term top. Do I think it's definite? No, I don't think we're definitely at a short-term top, but I do think there's certainly the possibilities there. But remember, the big problem is at this point, everyone pretty much sees that. That's the reason why I don't think anyone's going to be surprised that, you know, there could be a short-term top over after what we've seen. So that's why I wouldn't get too aggressive yet. And I'm a big fan of, frankly, I'm not a big fan of the pennies in front of the steamroller or catching the falling knife. I'd rather miss out on the absolute bottom or absolute top by a little bit, and then see that momentum, it has indeed shifted, and then go with that momentum at that point. So I'm willing to take slightly inferior prices relative to the optimal prices, just to have the sense that I'm really detecting a momentum shift. Here's the percent of stocks above the 50, pretty high, but gotten a lot higher, right? So than that. So you have to just keep this in mind. This is not really telling you this is an absolute layup. The 200 as well. Now, this could also be, right, there's your 200% of stocks above 200. This could also be the case where, again, despite the permeables out there that are giddy with glee, this really hasn't been as great of an across the board energy, financials, transports, small caps, everything's wonderful type of rally. They can continue to act that way. I'm not going to say at this point, 4 weeks ago, I would have said it's a very extremely narrow rally, but we noted that changed. You know, we move with, right, we move with the data, we move with the information, and we had noted that, like, let's give them credit. I still think it's forced buying. I still think it's more or less, hey, I better get involved rather than I really want to, but that's okay. And we noted that, right, sentiment can change. Price can change sentiment quickly. It's a well-known, it's an old adage. And what direction do the AAII members feel the stock market will be in the next 6 months? Look at this, right? If you go back to, where were we? Go back here, right? So just a few weeks back, 3 weeks back, you were at 27% were bullish. Notice, right, how suddenly you flipped around this dramatically. And here's the averages. Here's your historical averages. Look how much higher than the historical average this is right now. And you can see now there's optimism is above average for 2 consecutive weeks. We saw a really long run of pessimism. So this to me is not a good sign personally. Like, to me, like, this turns to be more of a contra situation, which is why for really the past 3 months, we've been noting that the sentiment was still not good, right? So the sentiment was poor and the market was rallying. And now the sentiment, now they can't get enough. They're all flipped around. What's happened in the economy, right? Or what's happening with leading indicators and other developments to make you think everything's wonderful suddenly? It's to me, it has to be that stock prices are acting much better. You know, that's my simple assessment, but you know, you can think about it on your own, of course. Now, this is something, right? We're going to have something in about 6 weeks, roughly speaking, another FOMC scenario will start playing out. And as of right now, there's almost a 75% chance, 3/4 of a chance, right? Probability, odds, whatever, that you'll be up slightly from where you are. Target rate here now, target rate higher then. And then, of course, by September, right, they've got it this way with a slight bet that it's even higher than that. So that, to me, again, my argument has been that rates staying up here longer, not coming off the way the gang tried to sell us that they would be coming off in May. A lot of people started, like they tend to do, pushing that story. I love how everybody flips on, the bubble vision, I call it. Right in front of the meeting, they start flipping their take on things. And we were going to get this pause in May, and that never, that pause would possibly reversal lower. That didn't happen. And now this is still leaning this way. Now, this is another thing we've been keeping an eye on. And I have a pick somewhere, but I'm not bringing it up because it's not that important. But we're definitely into extreme greed in CNN. Again, imperfect indicator, but something we can easily access. And here's your timeline. Here's where you are. I think it was at 83. Well, it doesn't show it there, but this is probably on a closing basis. But if you notice, right, this is the most extreme we've been now all year long. And this is the most extreme reading we have going back to the middle, let's say the start of the summer of 2022. So that just gives you an idea where you are. You could see some of the components, right, that comprise this thing. A lot of these things are in extreme greed. The only one they've got is neutral is the VIX. And I don't know if their VIX factor is, gauged properly anymore. I really wonder, but who knows, right? Who knows? But anyway, you can see that everything's at extreme greed. So just want to note that. We may as well note this another way, right there. This is a different plot. This is the CNN. They had it at 83 right there as well. I didn't note that when I put that in here, but there's the 83 reading. This is what you've looked like, right? Since late 21, you're even higher than where you were in late 21. So this is why I'm saying this is an extreme. I think the likelihood, the most likely scenario is you will look back on this and say this was somewhere near here was probably a great opportunity to sell. So another little factor, and I mentioned this on Cocktail Hour, if you've been riding shares, and that's your style, that's a whole nother separate discussion. But if you've been riding shares and you're not worried about the tax implications, I would just say, look, if you're still a bull, I think it's smart to roll into overall, basically liquidate those and get yourself into 40 delta calls. If you really insist on still being long here, and you might end up being right for all I know, but I would rather play this with, I'd rather play this with a lot less money on the table, with a lot less max risk, and just put most of my great gains under my pillow. That's me though. Anyway, I wanted to note this because this has been an important discussion. This is something that we take a look at, of course, all the time. And the VIX seasonality that came out courtesy of Nomura through Zero Hedge, this is kind of where you are, right? And you can see that we're getting to that point, which makes sense to me. The summer's the summer. Some of the worst non-holiday trading weeks I've ever experienced have been during my floor days in late August, when it seems like Wall Street is on vacation. And there's a couple exceptions, like with different crises that have broken out late in the summer here or there, but overall it's usually incredibly listless. In many years it has been anyway, but a good time to position yourself. So I would say, look, think about doing that. Think about positioning yourself for being smart about what you own, right? And this is something you can cover in the Phoenix portfolio with Ryan. We think we do that do we do that? Yeah, we do that on Wednesday afternoons. And I'm in there, but I'm so busy that I don't even have a chance to chime in anymore. So Ryan and I talk about some things, and Ryan's got his own stuff he wants to cover, but volatility is always a source of discussion. And there's a lot of things you can do. It depends on what you like and what you're comfortable with. But bottom line is, right, this is probably not a bad time to start, I think, owning Nove, owning Feb, vol, and maybe at least starting to, maybe not your full number, but then of course you're selling other vol in front of it. But anyway, just something to think about. That is, let's see, that is the, oh, and we're moving on to, so we covered this. We want to cover this now. So this is a week old, but I just wanted to note, to get on the record, that in case you didn't see last week, that we probably have a lot. This has probably jumped. I don't know where it is now, unfortunately, but this is a very interesting situation. So it's hard to say that this rally is hated at this point, which I think is a good point, and that this gentleman's making, Willie Delwich or Delwichi, I'm not sure how you even pronounce, probably Delwich, I guess. But anyway, that is probably even higher, would be my guess. And so with folks like piling in, it's getting up there. So anyway, just kind of note that we did that last week, but note that that's what's happening. Now, people say, well, you know, what could go wrong? Well, if you look at something like this, and I know this could be hard to see, but there's not much I can do about it because that's the way the graphic comes up. But right here, if you see this graphic, right, this is one that's there's a lot of other signs out there that suggest that, right, you're really close to a recession. But this is one of them, paradoxically, is when you're at full unemployment. So this is, right, this is the rollover effect of jobs being like when jobs being plentiful start rolling over, and then you start to see these really sharp upswings in unemployment. Now, this hasn't started really in unemployment, but this has started to roll over. So just be careful. Another reason I think to be careful and be smart about things, because this might be the missing element. I do think this is also where the government will get itself in trouble with getting extremely bogus with how they're reporting things. So when people start to see this continue to decline, should that happen, they'll wonder how this isn't going up, right? Because if it's tough to get a job, that means that the whole hiring thing's rolled over, and maybe we know there's been layoffs at big tech, that kind of thing, and then you'll start to see this potentially tick up, and you'll wonder, well, what's going on here? But I think that the shenanigans are very thick. It doesn't matter what type of administration is in power, they all pull it, but they all, you know, have different techniques, I think, at different times that they employ. This is a big reminder for people. This came up on the cocktail hour. So we've been working with this third presidential year, which is of the election cycle that we're in. And we've been noting on and off, mostly for most of this year, that this tends to be the best year of the four of the presidential election cycle. It's nearly double as good as the next best year, which is next year. So the other highlights on that are, this is how that pre-election year that we're in green typically unfolds, right? This is that seasonal pattern. And you can see that when you get into the middle of July, which we will be in about a month, right? That's going to get us to earnings season. That's when you sort of top out and you have this kind of listless stuff going on, little corrective activity that tends to bottom in October and then starts to finish the year strongly. So this pattern has been tracking fairly well. So we've kept including it. There were a few times when the market was not really performing that I thought, back here in April, I thought, well, they're leaving the presidential cycle kind of behind at this point, and I was ready to scrap it from the write-ups and some of the commentaries and things like that. But frankly, they caught up, right? And they've kind of reconnected. So if you want a final reminder on this, we are in the sweet spot between right, that runs from the start of the year, much like we have all the way again, I would say, to just a little beyond the first half of the year. And then, as you can see, right, you tend to get this kind of up and downish performance and with a strong finish towards the end of the year, and no one's surprised by that. So that gives you that idea of where you are. And so there could still be, right? This is why I'm, as much as I'd like to sort of get more aggressive with some things I have on right now to the downside, I don't think it's quite there yet. I'd rather take a shot when I see a little bit more weakness, and then see what happens from there. But I'm not just going to get more aggressive and leave it that way. If I see that they're holding and then starting to reverse things on me, I'll then do something else to address that and keep my position intact without a lot of theta, without a lot of capital that I could possibly lose. And then I'll try to wait and bide my time for another opportunity. That's how I like to actively manage things. But just wanted to put everything in perspective for everyone. So let's get into the charts again, and let's make sure we're covering everything. So I think things have advanced too far, too fast. And my one great way, I think, to show you how out of control things have become is really to take a look at something like, let's take a look at XLK, for example. And I think we're looking at about 10 years of daily data. So I know this is messy. Please bear with me on that, because it's really not about the price action. So yes, and we are. It's really not about the price action here. To me, it's really about the stretch. And if we just mouse over where we just were, I go back, right? This is going back several years, and I'll bring more data into it. But if you notice where we have been, this goes all the way back to 16 at this point. Let's see if we can get even a little more. And that's it. We can't get more data than that. So we're back in here to, it looks like, the spring of 2016. I remember it well. But this here, this is how extreme on the red dot the stretch has been from the 200 SMA and XLK. And the only time you could say that it exceeded that is when you had this incredible post-COVID response jam job. I think that was the year of the post-COVID response jam job, pretty sure. So yeah, that had to be. So this was extraordinary. Again, it depends on who you talk to. Some people say 7, some people say effectively $11 trillion was committed towards into the economy in terms of support in some ways. And so that's what produced that utterly insane ramp, right? But other than that, like, you really can't, other than something that extraordinary. Remember, if we round it off to 10 trillion, that's about half of the economy in terms of stimulus. That's an insane amount. And you can see that I think it was half the economy back then. Well, anyway, I think it's close to half the economy back then. Regardless, it's an insane number, and you're there, right? So that just tells you, I think, how stretched this is. And that's what you've got to be. Sure, you could say, well, what about stretch from the 100 and all that? Sure, that's fine. It's still extraordinary. And the Qs, right, as you may expect with the overlap between these two ETFs, the Qs are going to show something similar. And they've been the leader, so we have to keep our eyes on those. And I did put a permanent line up there so everyone can see that. And so going back 10 years on the daily, as far back as Thinkorswim will go for me right now, and I guess I could slide this over, but I don't think you'll see anything close. That's why I probably didn't naturally do that, because I checked it earlier. But anyway, you could see this is, other than that one, again, 7 to 11 trillion madness, that hyper madness in terms of support for the economy, really boondoggle, blah, 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 but whatever. There you go. I mean, this is other than that period, which is not something I've ever seen. I don't think any of us have seen before, right? In decades, maybe during World War II, for all I know, maybe there could have been something utterly incredible with military buildup, blah, 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 all that stuff that had to happen, munitions, everything really. But there you go. I mean, so this is an extraordinary sort of one-off-ish type of thing, very rare, maybe multi-decade thing. You don't see that for several decades, at least based off of the short-term history we had to work with. So right now, that just gives you an idea. And if you look at something like the XLK again, this is back towards the that high that it made back in 2022, or was it late 21? Looks like it might have been right near there. Doesn't really matter when it fell on. But the point is, let me get us to the point is that right now that you're up here, this could be right a stopping point. Could be, not yet, but you came within really less than 1 point from the high. It was 176.30 on this week's high, which probably got put in on Thursday, I would think. Or no, it could have been Friday morning. Let's see. Yeah, it was Friday morning. So that just gives you an idea. But this is extreme, right? So this is where you're operating, and that's the question I like to answer. And I don't want to belabor that and go into other things. So the colored dots are telling us that things are super stretched. I may as well just leave those up just in case anyone wants to check that out again. But let's go back to QQQ since it's broader and stuff. But those are the mega caps to me. Also, not only are they vulnerable because they've been leading this for the most part in terms of stretch, but they're also vulnerable because when they do have a strong year, now this could be an exception because it's sort of extraordinary underpinnings really to this rally in terms of the AI mania. But when they're stretched and they have this kind of a big move, there's often a rough June, and they haven't had a rough June. So that means the second half of June could be a problem for mega cap. That's something that's been, let's say, a phenomenon over the last 10 years or so. We'll see. That's sort of barely there, right? It's barely clinging. I still think they did. I do think they broadened the advance. We talked about that. It's just too far, too fast. The colored dots are showing the stretch. Valuations now are insane in some ways. Again, I'm at DEFCON 2. They crushed the put call ratio. The VIX has been immolated. We talked about the VIX. The rally did cause capitulation. I think that's what we saw. I think a lot of shorts were liquidated above 440 in the SPY, and people that were holding on against the level we've been talking about that really created that. I'm sorry, not 440. I did see some liquidation above 440, probably because of the round number effect and other things, but also above that 432 that we talked about. This is where I think, that's why I said this sleeper scenario to me makes sense, that I think a lot of people would capitulate here and say we're now in a new bull market. And now there's no doubt about it in their minds because a critical high was taken out. And I don't think, I do think that happened. And I do think 440 liquidated people. So I think with them now having their largest active exposure, as we noted, I think they're trapped. This has been my whole sleeper scenario premise, where now they're trapped, and that sets up for strong corrective potential. And I think a lot of them have just front run the recovery. So there's a ton of money that's gone into many things, in my opinion. I've looked at a lot of different things, and I see a lot of money really got committed. And so you all know the old everyone's on one side of the boat thing. That to me is very concerning. And so that can really tip the scales ultimately here. So just keep that in mind, because it might not be immediate, but a lot of people might be slow to realize, since they maybe just capitulated and have front run this incredible recovery that's on the way. They might be slow on the uptake to say, oh no, things aren't as they appeared to us. We're going to now do this, that, or the other thing to reduce our exposure. That crowd might be late, and eventually that could lead to a lot more downside when they finally have that recognition. If, right, that continued weakening and the wheels start falling off of the economy happens. That's still the big if. We don't know yet. We don't have the data on that yet. So I do think there's been panic, premature buying, as I noted. I still don't think the economy's flashing anything special right now. They have priced this, again, I think beyond perfect. And it's really been not about the 12-month forward EPS guidance going up. It's really been more about valuations going haywire, one of my favorite words. And then extrapolating I just think they're extrapolating too much good news into their discounting of prices, right? Of where they think this thing should be priced at. I think that sentiment has improved, right? And that clearly, and that's of course causing even more buying. I'm not so sure that these people that are having their arms twisted and becoming bulls, I'm not so sure they're sticking to their investment discipline if that's the case. But remember, that's just me, my sense of things. That's not something I could sit there and prove. So just keep that in mind. It's just really just a take that I have. The AI thing is causing the 99 2000 scenario, sort of sign of the times, zeitgeist, whatever you want to call it, to happen. There's a little bit of 87, I think, sprinkled in, that some people have made the good point that, look, the market did something similar and rallied really throughout the summer, even into the face of, I think it was rising rates or slowing to some degree. And then, of course, you had a major correction. So the data to me just isn't there yet. I still think there's potential for stagflation. I still don't see the world roaring. What I saw out of Japan's doing better apparently, but I still don't see anything in Europe that's really exciting in terms of, hey, they've turned the corner. Same thing really with China. I don't see anything extraordinary yet from China. There's always rumors that Chinese may do this, that, or the other thing, which, I think with so many, let's say, Western countries, mainly the US, but Western countries sort of apparently, right, disinvesting or reducing reliance or relations with China economically. That to me, I don't know if China's as important as it was, but the bulls will never stop for a minute to worry about anything like that. If they do start to see good stuff out of China, would be my guess. So we talked about all these things before. I'm not going to go through buybacks, gamma squeezes. Even though there's better sentiment reading, I still think there's a lot of people that hate this market, which is good for bulls, right? I still think there is that. So even though it's sort of like what you're saying, it's both ways. I do still think there's a lot of people. A lot of people have capitulated, but I still think a lot haven't, and that could help bulls. Right? We have to be honest about it. So they're still saying liquidity is set to shift to a headwind. That's the talk, but clearly it hasn't really dampened anyone's spirits yet. And then the bottom line, which we should probably start to think about wrapping up here, is the market. To me, this is all to me, just my humble opinions. I think it's ignoring important data. I don't think Europe and Asia are doing well. I already mentioned that. Very overbought finish for the week. The FOMC expectations or rates still go higher. And I think the only problem is, right, games can still be played here because they could still eke more out of this. And it wouldn't be something that you just, as extremely overbought as it is, it wouldn't be unprecedented, right? And I think they could feed upon the fact that they've got their earnings coming up and they're going to get their beats, right? It's all engineered BS. So you got to know that, right? That if possible, if at all possible, they will spin the earnings that start trickling out about a month from now in a bigger way. They will spin that, right? So you have to be prepared for that, and that could mean, right, we have a lot of back and forth. Who knows? We could have back and forth until then, but I think you have to be ready. If anything really starts showing that this economy is, there's nothing happening economically here, they might still cheer that on, that bad news is good news. But to me, it just, with rates staying higher now, it would appear for at least 6 more weeks and unlikely to come down for 6 more weeks and more likely to go up in about 6 weeks. To me, these are not good things for an economy that is not really firing, but that's me. So I still think you've got to keep yourself grounded, right? I think it is time to go as a bull. I would be at DEFCON 2. I would consider counter trend trades, but I think you need to see the momentum shift. And then you would be kind of back at DEFCON 1 at that point where it's time to be very defensive or be aggressive as a bear. But we still we're kind of like teetering near there, but we're not quite there, I don't think, yet. The sleeper scenario has its chance to shine now because we did get that kind of super melty push beyond the 432 level in SPY. So let's see if it can come back. Let's see what happens if they bring it back towards there, right? That would be a nice retracement level. That would be about 2%-ish from where we are right now, maybe a little bit less than 2%. Maybe it does come down towards there, and then they possibly convert what was likely to be resistance and kind of did act as resistance. These highs are a little bit below there, but you get the idea, just a little bit below there. And then if they convert that to support, remember, they'll back the market off, taking the extreme overbought readings out. They might go for another run. So that's one scenario you can't rule out. I still don't know what bullish drivers these people are looking at. They're trying to say this. I've seen a couple things they've tried to hang their hat on. I just think the overwhelming weight of the economic information that I look at, that's helped me for a long time to kind of be able to, I think, look past what's happening in the charts and kind of still have that fear of what could happen, that healthy fear of what could happen for risk management. That to me is still not there, but that's a whole nother discussion sort of. So as I noted, right, you're due for the pause or pullback, but everyone knows that. So you've got to be careful. So it never gets easy, right? Rarely, I should say, does it get easy, but there's a gap back here if things really go off the rails, but you just don't know. So I think you got to take it as it comes. I would use that 432-ish. I'm sorry, 432-ish is a possible pullback area. See, there's a fib back there. So let's see what happens if we do get a pullback. But if you want to get aggressive, I think you have to really be somewhere near this 436, and sort of like, I'm telling people to wait it out before they get in. And I am, because you really don't have enough to hang your hat on, I think, to say you have a real reversal scenario forming yet, because you just haven't seen the momentum shift back the other way enough. But if you want to play in a more aggressive game, and I don't blame you, by the way, if you do, if you're experienced, well, what I would do in that case is, these two areas are where you've got to look at, right? That you've got to put a little bit of a buffer here. And if you do kind of open on Tuesday after the holiday, you open up near here, I would wait for the momentum to start reversing lower in some way that is meaningful to you, and then use this, whatever high is there, and put at least a 0.5%. I'm sorry to say that, because that would be a couple of points, but I'd put 0.5% above there as a possible stop. Otherwise, I think they can click you off pretty quickly. So that would be my basic assessment of all these different things. I tried to cover a lot of things. All I'll note is, just in closing, is that the dollar has come off, right? So that's good for stocks. No surprise that happened. So stocks have gone up, dollar has gone down. I say dollar has gone down to Thinkorswim. You can see that. Or can you? Let me get back to like 3 months so everybody can see this better as we wrap up. But you got that, and then you've got the TNX, right? So the 10-year yields, they're kind of churning right now. I don't, it's hard to make a lot out of those right now. You can see that, you're basically right. We're where we were on this low, back 3 weeks plus ago about. So nothing really happening there. So that's not easy. And then VIX, of course, is the one I would get active on. Not itself, but you find the areas where you want to be long volatility. Like I said, Phoenix portfolio, even if you sign up for just a month or two, it could make a lot of sense, because you can bring up any macro question or longer term strategy or hedging. That's where we cover all that stuff. Probably needs a name change, really, but the idea originally was try to find opportunities that were really beaten down. But unfortunately, during this time, there's been a lot of just jamming, where there's not been a lot of great, let's say, really beaten down names that have been down for too long, that you had a lot of confidence in. But still, trades get put out in that every week, 2 or 3 trades. But this is this is near the lows, maybe not at the lowest lows, but near the lows. So I think you've got to be ready for. Now that's so odd to me, is that I felt like we had a lower reading here. What am I thinking? Well, I guess I'm wrong. I guess this is the lowest low. Maybe the data was revised. I thought we had a lower low than that dipped into the high 12s. maybe that was just my expectation and it never happened. But yeah, this is clearly right, super, super low. So I think it's your chance to start to at least position yourself. And again, I would talk to Ryan. If you're in other webinars, I would talk to Ryan about that. You could say, hey, Wayne mentioned that, or I've been thinking about it, whatever, in another webinar, and then get Ryan to chime in on that if you're interested in other things, right? Beyond just the shorter term trading, you want to get a little more, let's say, strategic, and then have some tactics to discuss within there. So on that, I think I'm going to wrap it up and I'm going to stop the share. Let's see here. And why am I getting such trouble here? Yeah, I don't know. It looks like it might have had an issue there. But anyway, on that note, I'm going to say thank you for tuning in. I hope something I shared with you helps you out this upcoming week or sometime in the future. Everyone have a great holiday weekend, and we'll be back at it on Tuesday. Everyone take care and stay safe. Enjoy yourself. Thank you.